Ladies and gentlemen, thank you for attending this OTC Markets webinar. During the course of this webinar, you'll hear about the OTCQX and the OTCQB and how to use these platforms to gain access to globally significant US investor market. As many of you know, the OTC is the premier market for international companies looking for a fast and cost-effective way to interact with the US investors. While there's certainly been a historic view that listing in the US and accessing these markets can be a resource-intensive and costly process, Violet and the team at the OTC and the advisors that you'll be hearing from today are here to talk through their rapid listing process and how long you should expect to take and the costs and the steps involved to accessing these markets. Australian ASX listed companies are certainly changing their tune when it comes to accessing the US market. In the past 12 months, 35 ASX listed companies have chosen the OTCQX and QB as their entry points to the US market. And I understand now there's well in excess of 50 ASX companies across these two markets. Clearly, it is an opportune time for companies to tap the US market. The format for today will be a presentation from the team at OTC and the advisors who work with the OTC, followed by an interactive Q&A, giving participants the opportunity to directly ask questions of the presenters. And you can do that by submitting questions in writing. I would now like to introduce the presenters. First, Violet Pagan, OTC Markets Vice President of International Corporate Services. Andrew Riley, Partner of Rimon Law. Stefan Spath, Managing Director of MCAP Markets, LLC. Violet, over to you.
Mute. Thank you, David. Good morning, everyone, and welcome today to our webinar on accessing the U.S. capital markets. I'd like to take a moment to thank David at Chapter 1 Investors and Blake at Atomic Share Registry for hosting and supporting today's webinar. I'd also like to thank Andrew Riley and Stefan Spath for joining us today as we discuss the OTCQX and OTCQB marketplace. Can we move to the next slide, please? For Australian issuers, there are clear benefits for expanding your corporate footprint in the US, which has the world's deepest pool of capital and the largest high net worth income population. Cross-trading in the US on the OTC market diversifies a company's shareholder base and positions a company to appeal to those investors and broker-dealers who prefer to make markets and securities that trade during US trading hours and settle in US dollars. Move to the next slide, please. The OTC market operates the largest ATS, an alternative trading system. It's the largest ATS in the US. There are over 11,000 securities quoted on our market. Our ATS provides the technology and platform for brokers to connect and trade electronically. OTC Markets is a highly regulated SEC-registered trading venue of choice for both investors and brokers. Currently, there are 81 US registered market makers trading Australian securities in our marketplace. And these are the same market makers that trade on NASDAQ and NYSE. These market makers have orders routed from 3,500 brokerage firms that represent 624,000 financial advisors in the US. The first quarter of 2021, $3.3 billion of Australian securities were traded on the OTC markets. Moving to the next slide, please. The OTC market organizes its securities in three markets: the best market, OTCQX, the venture market, OTCQB, and the open market, the pink market. Companies seeking an upgrade to the OTCQX and the OTCQB market utilize the U.S. Reporting Exemption Rule 12G32B, which enables foreign issuers to leverage their home market disclosures and reporting standard to trade in the U.S. Both the QX and the QB marketplace are cost-efficient markets designed to reduce trading frictions for investors and improve the marketability of a company's security in the U.S. through greater transparency and visibility. Issuers whose shares are quoted on the OTCQX and QB markets often experience greater liquidity and increased market depth. The pink market is a market with limited financial standards and disclosure requirements. Some of the pink companies include penny stocked shells, distressed or delinquent companies. We encourage companies to upgrade to the OTCQX and OTCQB markets to remove the trading frictions for investors. Next slide, please. This slide speaks to the OTCQX and the OTCQB solutions for the challenges that issuers face. The first challenge is trading. Most US investors just want to put in their trading symbol in their brokerage account and settle their trade same day US dollars. The second challenge that issuers face is actually the brokers. Many of the brokers have high internal risk controls, so they're unable to trade certain securities. So a broker like Interactive Broker does not want to trade non-DTC eligible securities. A broker like Merrill Lynch will have limited trading in pink securities. So the OTCQX and the QB markets allows for these brokerage firms to access our compliance data, which enables them to trade seamlessly. The third key challenge is transparency, and I'd like to refer to this as a disclosure evolution, which our market has been working through. A company's news, research, and financials are an integral part of an investor's decision to trade in a security. So the OTCQB and QX market provide the company's information to investors without the company having to duplicate its disclosure efforts in the US. So you're not traded on NYSE or NASDAQ where they have separate requirements. What on the QB and the QX market, whatever you're disclosing in the local market will transfer over to our market. So it's not duplicative. Next slide, please. One of the most important things about our market is this the concept of blue sky compliance. Excuse me, I have like whistling S's. But so blue sky laws are state laws that regulate the offering and sale of securities. Blue sky laws are designed to help investors make informed decisions by mandating that companies disclose accurate and current information when marketing securities. So each state in the United States has different blue sky laws. The OTC markets has worked with these individual states to have the OTCQX and the OTCQB markets recognized by each state. So currently, the OTCQX market enables blue sky for 37 states, and the OTCQB enables blue sky for 34 states. So, and this is really important because some companies think that they can get a manual exemption, but unfortunately that manual exemption comes in and out every day. So Simmons, which is a depository receipt program, recently lost their blue sky registration in many states. And, you know, brokers were calling and portfolio managers were calling us and saying, okay, well, why can't I trade this security? And it had to do with the manual exemption being out of form on that particular day. But if they were listed on the OTCQX and QB markets, then that blue sky would be consistent throughout the life of the facility. Next slide, please. While disclosure and compliance are the foundation for the OTCQX and the QB marketplace, we do want our issuers to continue to market their security in the US. We encourage issuers to maintain a visibility in the program in the US and also utilize our services. So you can set up the trading platform, which is what we are, but without visibility, without an IR strategy around your US investment vehicle, it will be sort of a moot point. So we highly encourage companies to utilize our visibility program, connect with an investor relations firm, do non-deal roadshows, come to the US, tell your story. Don't just focus on the markets that the California, Boston, and Chicago. You want to also go to the Midwest where there's high net worth individuals who have deep pockets as well. We recently, and over the last 3 years, bought the virtual investor conference from PR Newswire. And that has enabled us to do, during the pandemic, these virtual conferences, which have been extremely successful. The last mining conference we had, virtual conference, we had about 6,000 attendees. Our database of investors are about 90,000 to date. So as we roll out these virtual conferences, and sometimes they're thematic, sometimes they're based on countries or industries, we encourage you to actually participate. And the conferences provide for one-on-one meetings, and you get the investor information sent directly to you, and it plays on our website for I guess a 90-day period, so that you can investors who miss the conference can still view it. The other thing is it says here that our website gets about 5 million hits a day. During the pandemic, we're up to about 15 million hits. 5 million hits a month, but up since the pandemic, it's been up to 15 million hits a month. So having your information on our platform is vital, and it's important, as well as the trading platform. So I'd like to now turn the discussion over to Andrew Riley to discuss the upgrade procedures. Thank you, Andy.
Thank you, Violet. And if you could turn the page, please. Thank you. Just by a brief overview, again, my name is Andrew Riley. I am a U.S. securities lawyer based in Sydney. I've been here 23 years, so advising Australian companies accessing the U.S. capital markets, including dozens of those who are quoted on the OTC markets. So now that you've heard from Violet, the great opportunity of having your shares quoted on the OTCQB or QX, many of you will be thinking, well, there's the great benefit. What's the cost, or what's the pain I have to go through? And happy to say very little pain, particularly from a US perspective. I can tell you this is about the easiest process. It's nothing like an SEC registration process that some of you may have heard of. To start off the process, you do appoint what they call a sponsor, which is typically a lawyer like myself or a broker like Stefan, to help shepherd you through the process. And at the end of the process, actually deliver a letter to the OTC markets, confirming that the company satisfies the eligibility requirements. So what are those eligibility requirements? Actually, for pretty much any Australian company listed on the ASX, you would qualify either for the QB or the QX. And the basic difference would be for the QB, basically having a share price of at least 1 US cent. So that's not asking too much. And then for the QX, a bit higher, 25 cents US for the preceding 30 days, a market cap of $10 million and $2 million, at least $2 million in net tangible assets that the company's been operating for at least 3 years. There's an application process. Again, it's pretty straightforward, actually. Don't ask too many funky questions. And once that's been submitted, there's a review process, and then the OTC markets asks the company to upload what they call a company profile, which again, pretty straightforward, financial reports, and basically everything you've lodged with the ASX for the prior, certainly since the beginning of the prior fiscal year. One of the issues that comes up is whether the shares are already been quoted on the pink sheets. So if a broker has already initiated a market on it, and if not, there is a process to go through with what's called FINRA, which is a regulatory body in the US, not part of the SEC, but they do regulate brokers as well as the OTC markets itself. And that maybe I might hand over to Stefan, because he's the man who actually helps shepherd through companies who are not already in the quote pink securities, and many Australian companies are, by the way, without even any of their involvement or knowledge. Some brokers in the US may initiate this process on their own. But Stefan?
Sure, to shed some more light on that whole process. So we have, in addition to the OTCQX QB in pink tier, we have something called a gray market, which is a place you never want to be. But in the event, as Adam suggested, is that we have companies that have been traded in the US because there is demand and interest amongst US investors. And so as broker-dealers effect trades in the security for settlement purposes, they have to create a US symbol. But that symbol is always going to be in this gray market just for settlement purposes. until a market maker files a Form 211, which is the regulatory application that a market maker has to go through in order to create a U.S. ticker symbol and settle the trade. So that's kind of the back mechanics of how the process works. It's also one of the initial requirements to apply for the upper tiers of the OTC marketplace, the QX and the QB. And we as a market maker, we're that one component of that process that can do that. Other market makers as well, but we happen to be an approved sponsor in the process. But one of the interesting things about the market making component is that as an over-the-counter traded security, you're technically not listed on a national exchange. You're quoted on a trading venue. So the OTC QX and QB are trading venues. And so the role of the market maker is really the counterpart to the specialist on an exchange. And for a company to have an interest in cross-listing in the States, the entire point of the exercise is to have effective market making going forward, so that as you employ IR strategies and you have roadshows and you engage in some of the services that the OTC markets offers, and you develop interest, visibility, and an appetite amongst U.S. retail investors, once they have got your attention and they want to buy the security, there has to be an effective trading platform with effective market makers who are putting up capital to effect these trades. And that's where we fit in the entire process. So that's the 211. It sounds, unless people have an interest in reading up on U.S. securities laws, I know it seems pretty abstruse, but that's the very key, crucial component of the process. And we can help shepherd you through that process, as Adam suggested. And that's where we are.
Thank you, Stefan. And then actually to cost, there's the next item on the slide. Violet's smiling there. So there is an application fee of $5,000 for both the QB and the QX. And then the annual filing fees, you can see there, $14,000 for the QB and $23,000 for the QX. A bargain, an investment, well worth it. And then the last thing again is the sponsor, whether it be a broker like Stefan or a lawyer like myself, submit a letter of introduction certifying the company satisfied with the requirements, and then you're off and trading. The whole process for a company that's already quoted in the pink sheets can be done in a few weeks. One that needs to go through the 211 process can be a bit longer. But with Stefan on board, it can go very quick, of course. If you could turn the slide, please. Now, once you've been quoted on the OTC, trading occurs there. Settlement actually would occur, at least initially, in Australia via the CHESS system. In order to have settlement in the United States, the company must have what we call DTC eligibility. The Depository Trust Company is a big monolithic organization owned by the big investment banks, and it's essentially a clearinghouse, and that's through which securities settle in the US. So in order to do that, a company needs to get its ordinary shares eligible for DTC trading. And the main part is, well, maybe I'll hand off to Stefan. The main thing is the US broker submitting an application to the DTC. So may I hand over to Stefan to talk through that.
Correct. So the DTC process is not tremendously unlike the Form 211 process, where we have to go through different agencies. With FINRA, they are a secondary regulator under the SEC, but with the DTC, it's a private corporation. However, in order to have shares electronically settle in the United States, a DTC participant needs to file the application. So it's a third party away from the company and away from the market maker that does this. That process can only occur after the US symbol has been created, if there isn't one. So after the Form 211 is cleared, DTC component comes next. That process can typically take about 2 weeks. It's a very straightforward process. Very rarely would a company be denied treatment for DTC service. Basically, we also can shepherd you through that process. Requires different information than 211. We would need to have a share certificate to put on deposit, as Andrew said. And in addition to that, just other questions that the DTC needs to tick some boxes off of. But it's a very straightforward process. It does facilitate trading. One of the other benefits is that without DTC eligibility, Australian securities can still be traded in the US amongst US investors. However, there are certain broker-dealers that either don't allow it to happen. And so I think Violet mentioned earlier, Interactive Brokers has issues with non-DTC eligible securities. In addition to that, there are a few discount retail brokers that also don't engage or allow their investors to trade non-DTC securities. But those who do, some of the larger broker dealers, the bilge bracket firms like the Morgan Stanleys of the world or Merrill Lynch, they may assess a higher fee. Maybe there's a ticket charge for a retail investor to trade a non-DTC eligible security. So it's not the end of the world, but if the entire point of the exercise of cross-listing is to make the process as efficient as possible for US retail investors, then having DTC eligibility is really, I would think, a very good idea. And it should be packaged and thought of all as one step closer to becoming an efficiently traded security in the US over-the-counter market.
Well, thank you, Stefan. And the last thing you mentioned, of course, the last point there is the legal opinions. DTC will ask for both US and Australian legal opinions. They're particularly concerned about this Australian stamp duty thing that exists down here. But again, it's a fairly straightforward process we've gone through with a number of companies. The other thing that is pointed out on the slide is, as you have a share registrar here in Australia, if you do get the DTC eligibility, you would need to have the equivalent in the United States, a US transfer agent. So you'd basically be having two books and the shares would be going between the two. Violet, I don't know if you have anything else you would like to add on DTC eligibility.
With respect to DTC eligibility, I know, Stefan, you said it takes a couple of weeks, but we found that some companies have had some difficulties with just getting the deposit done properly with DTC. So what I've been saying to the Aussie issuers is that you have to set up the QB and the QX facility to begin trading. And then once you've done that, then you bring the DTC portion on board, but it's not, it should be sort of taken separately. You do one and then you do the other. You don't do them together, because if you try to do them together, it'll just take forever to set up the program and begin trading. So I would just caution companies that who think that DTC has to be done immediately, that it doesn't have to be done immediately. Like Stefan said, there are Merrill Lynch will trade securities that are on the pink market, the QB market, without DTC eligibility. And then the other thing to consider is that the ADR programs already have DTC eligibility. So when you uplist to the QX or QB, that's not an issue. You wouldn't have to do that separately.
Thank you, Violet. If we could turn to the next page. Thank you. That is a cue for me. Legal considerations. I think as Violet mentioned, one of the main things for Aussie companies listed on ASX is, why does the SEC allow these securities to trade in the United States without going through the very rigorous SEC registration process? The SEC has an exemption for what we call foreign private issuers, so the non-US companies, to have their shares trade in the secondary market in the United States, and that's pursuant to this rule 12G3-2B. The main requirements are that the company have a primary listing outside the United States, so i.e. Australia, be listed on ASX, and publish annual reports and other documents in English, and it'd be publicly available. So again, ASX. So essentially, every Aussie company listed on ASX will satisfy this requirement. Again, it's only for secondary trading only. It's not for the raising of capital. If you want to raise capital in the US and the US public market, then you do have to go through the SEC registration process. And there are at least over a dozen Aussie companies who have done that, who are SEC registrants and do raise capital in the US public market. That being said, a lot of Aussie companies, and probably advised on over 100 over the last 15 months, do raise capital in the US private market. So you can issue shares in a private placement to particularly institutional investors in the United States as a private placement, so exempt from the SEC registration requirements. There are restrictions on those investors from reselling onto OTC. The US has a system where we track unlike ASX, once you're listed up and running, you do a placement here in Australia and the shares can immediately trade onto ASX. In the US, it's not that way. The US investors cannot resell on OTC for 1 year. They can resell their ordinary shares on the ASX immediately though, that is permissible. And the other restriction is on in the US of the concept of affiliates, which are officers, directors, and major shareholders. And there too are restrictions on the ability of these affiliates to sell their shares onto OTC. It can be done, but something to keep in mind. And lastly, a lot of people ask, oh my God, I've heard of America, they sue a lot. True, but in the 23 years I've been here, one major development is, particularly the last 10 years, Australia has become very litigious and is now actually number 2 behind the good old USA for securities class action lawsuits. Personally, I think a lawsuit is more likely to occur in Australia than in the US, partly because for an Aussie company, it's a deeper market in Australia. You have a lot of litigation funders around here in Australia, and it's a bit arguably quicker and easier here in Australia than America. But yes, the anti-fraud laws do apply in the US. Next slide, please. Thank you. As Violet mentioned, there is something called these ADR programs. These are American Depository Shares. And just for those who aren't aware, that this concept of these ADRs were developed, I believe, after World War II, when America just learned there was a world out there and wanted to invest in the world, companies in other parts of the world. And there were restrictions on trading, either foreign ownership of companies, foreign exchange controls, other restrictions on the abilities of Americans to invest overseas. So the ADRs are essentially a US security. Underlying each American depository share is a certain number of ordinary shares. And so that helps facilitate the raising for Australian companies. And by the way, these programs are still very important, particularly in, if you want to call it, developing countries. And Australia, of course, there aren't the foreign exchange controls, there aren't the restrictions on foreign ownership. So it's easy for Americans actually to own ordinary shares. So a lot of companies debate, do I want to have ordinary shares or these American depository shares trading on the OTC? I think now for small companies, listing or quoting of the ordinary shares is probably less expensive, less cumbersome, because the ADR programs do have maintenance cost that the depositories charge who set up these programs. For larger companies, the ADR programs may be more attractive because the depositories can earn a bit more money and they might share some revenue. And as Violet had mentioned, one benefit of the ADR program is that this concept of DTC eligibility is automatic for ADRs, whereas with ordinary shares, you need somebody like Stefan to help you get through the process. Corporate actions are also a lot easier with ADR programs. And for investors, I've always kind of wondered, some investors prefer the ordinary shares from some of the ADRs. The ADR program may, depending on how big they are, may be a bit more expensive. Some institutional investors prefer the ADRs because they're technically an American security. On the other hand, some perhaps non-institutional investors view ordinary shares as, quote, more American, easier to trade. But Violet, do you have any thoughts on this?
Sure. So the ADRs are, thank you, Andrew. The ADRs are great for companies who want to get access to institutional investors and pension funds and separately managed accounts, because technically they are a US equity. So they're a derivative equity of the foreign share. So the ADRs do serve a purpose for those companies who want to have access to those pension funds and those SMAs. But for smaller companies, it may not be the perfect fit, but they do hold a benefit for the larger companies and for the companies that are going forward and looking for these broader investors. So we would recommend that companies speak to the DR banks so that they have a greater understanding of the ADR programs. And ADRs are used for uplistings to the NASDAQ or NYSE for capital raises. You can have a 144A Reg S ADR program that once the shares are seasoned after the private placement, they can then trade on the OTCQX market or the pink market. So after a seasoning period, the Reg S, it's 45 days. The 144A is up to 12 months. So we do highly recommend that you do speak to the ADR banks should you want to consider an ADR program, a capital raise, a broader investor base. So, but for our purposes, for the smaller companies, the foreign securities are probably the better route to go on our market.
Thank you, Violet. You can turn the page, please.
So this is going into MCAP, so I guess I'll step in here. I put this slide up here just to let you know that one of the things that I think allows MCAP to differentiate ourselves from some of our competitors is that we are an exclusively non-US security trading company. And we think that dovetails quite nicely into our role with the OTC because we focus on bringing non-US companies to the market to create more visibility so that we can show our institutional customers that the list of foreign securities on the OTCQX and QB is growing. As a matter of fact, they hit a milestone last week on Wednesday where I believe, and Violet, correct me if I'm wrong, I think OTCQX hit their 500th company on Wednesday of last week. We played a small role in that. Yeah, so I've been involved in this since 2007. And we think it's a perfectly well-fitting approach to bring foreign companies to the US so that the tremendous amount of demand that we see from our institutional customers to have more foreign securities that we can trade more easily, it makes perfect sense. And so OTC Markets has created a platform to allow this to be so seamless and so easy that it's almost, to use the term that I don't even like the expression, but it's a no-brainer. And so this, I put this up to show some of the other things that we do. We consider ourselves to be a technology company. We have a team of software programmers that develop proprietary trading platforms for our traders to more efficiently get best execution for our customers and also for retail investors that are behind those institutional customers. And it's perfectly aligned with the major idea of OTC Markets, which is how do you bring more visibility to the over-the-counter space? How do you allow U.S. investors to have easy access to foreign markets during U.S. market hours, quoted in U.S. dollars? And so that's why we kind of do what we do as far as investing in technology. We could probably move to the next slide. So this is just to kind of give you an idea of the breadth of what we do. We have an international equity market making team. I'm a part of that team. We do have a fixed income team, which may or may not be relevant for whoever is listening. And the OTC advisory services, that's what we've been talking about as far as one of the initial requirements to become quoted on the OTCQX platform is to nominate a sponsor. We are an approved sponsor, so is Andrew. And that's what I kind of manage on my side. So we like to collaborate with our other sponsors, and we like to bring more companies to market, and everyone has their own specialty. So for instance, when it comes to the legality of the process, Andrew's a specialist. But when it comes to the aftermarket, here we are, now we've done this, we need to make sure we have an efficient market making capacity. That's where we come in. And so I think we complement each other quite nicely, Andrew, in that sense. And that's just us in a nutshell. And I'll just say briefly, we, MCAP, our team has been together. It's a team of about, we've grown tremendously in the past several years, but the core team is a team of my partners. We've been together since 1997, specializing in only foreign securities. So they've developed a pretty good specialty in knowing the nuances and intricacies of non-US equities, different settlement dates, different securities laws, different settlement times, but also different holidays, things like that, corporate actions and how they're treated. So I think that what makes us different than some of the other market makers out there is that we exclusively deal with this, and you tend to get better at things that you are focused on. So that's what makes MCAP unique. So let's go to the next slide to see if there's anything different there. Oh, that is, I think, Violet.
So recently, we've added about 35 companies on our market. We're pleased to have brought on BrainChip recently, Ecograph, Matador Mining last week, Novonix earlier, late last year, Tiny Beans, Freelancer. If you've seen the market open video, that was one of the best. The company actually did it in their office and it was great. Champion Iron out of Australia, but their base is in Canada. And we have a lot more coming on board. So we're pleased to have you all join us today. Thank you all. And thank you, Andrew, and thank you, Stefan, and thank you, David.
Always a pleasure.
Thank you, everyone, for such an insightful presentation. We do have the opportunity to ask these experts a number of questions, and it is very rare to have a group such as this together to be able to ask these questions. I would also like to introduce Blake Stelzer, Executive Director of Automic Group, one of Australia's leading share registry groups. And maybe I'll start by throwing a question to you, Blake. As a share registry organisation having to deal with companies looking at an OTC integration, how easy, difficult, what do companies need to think about from a share registry point of view as they look to make that opportunity into the US?
So from a share registry point of view, the main difference is with DTC eligibility. So where there's a need for a second registrar, which is known as a transfer agent in the US, to effect settlement over there. So we help our clients with identifying a transfer agent partner that sits as a co-transfer agent, which we shunt securities back and forth with. That's the main thing that affects a share registrar. Other than that, it's quite a simple day-to-day process.
And are you seeing an increase in the number of your clients looking at the OTC, QX and QB as an opportunity to access those US investors?
Oh yeah, without a shadow of a doubt. I'd say over the last 12 months, inquiries have gone up a significant number. We're speaking to a lot of our clients about the opportunity.
A couple of technical questions for you, Stefan, as they come through, and just to remind everyone just to submit questions in writing and we'll get through them as we go. Stefan, does a market maker end up with a long or short exposure in a company, and is that hedged by the ASX listing even though they aren't fungible?
Yes, so I'll give you an example of how this looks mechanically. Once we create a US symbol, after the 211 is cleared, the market maker will publish a quotation in the OTC link system. So we'll have a bid and an ask. So as investor demand increases and we are routed by orders, we sell the customer the shares. That creates a short automatically. So we have put capital at risk and we have an exposure. But then when it comes to an Australian security at 7:00 p.m. that night, the trader goes to Australia and buys the shares locally. And then there's a T+3 day settlement cycle. And then the new investor, the shareholder, now has the shares in 3 days. So that's the actual risk of the market maker. And that's the interesting component of the over-the-counter marketplace. Unlike a specialist on a national exchange, is that market makers are competing with one another to have a tight market in order to have best execution. But yes, it's a risk capital business, but there's no hedging. The only time there would be hedging involved is if there is a large position, and every broker dealer market maker has their own internal guidelines on position limits and things like that. If we're dealing with something that's quite sizable, say a $5 million position in an Australian security, the trader might decide either we can hedge the currency component, or we can buy or unload some of these shares and, on a competitor in order to mitigate the risk. So there is a mild hedging component from time to time, depending on the size, but basically we're going to the local market, we're buying shares, and we're delivering them, which is why with a cross listing, as time goes by, you see an increase in volume, not just in the new market over here, but also in the local market in Australia. And so that benefits everyone to see that volume increase. We're essentially a conduit between the US investor and the Australian local market.
Another question, and I'll open this to the floor. If you're trading as an OTCQB company, do you automatically start trading as an OTCQX if you meet the qualification criteria, or do you have to reapply?
You'd have to apply for the QX upgrade. It's not as cumbersome as the initial process, but you would definitely need to apply for it.
And in terms of volumes, we've got quite a few questions here relating to volumes. Have you seen an increase in volume? I know you referenced website hits and access. Has there been an increase in volumes across the OTC QX and QB in the last 6, 12, 18 months?
Absolutely. I think the slide, if we can go back to slide 2, there, it's increased, the next one right there, from 32 billion to 75 billion. So it's based on what's happening in the markets recently. All of these retail investors coming on board, Robinhood trading, it's just been a fantastic first quarter and of this year, and last year was phenomenal as well. So we have seen a significant increase. We're of course wondering if it's going to be sustainable. And I guess that's what's in everyone's mind. Is this a sustainable volume of trading going through our markets? And we think that it will not be sustainable at this level, but it will level off it will normalize, but it will have increased substantively. So yes, we have been seeing phenomenal volume coming through our markets, even the pink securities. So when you see there's 600 companies, Aussie companies on our market, that includes the pink companies. And we've been seeing tremendous trading on some of the mining companies, the biotech companies. Yes, absolute increase in trading volumes.
And again, maybe a question for the floor, but are there certain types of ASX listed companies that appeal to US investors, or is it more an open slather? As long as they've got a good story and a good story told well, good management, well funded, then there's interest? Or are you seeing trends in terms of sectors or parts of the types of ASX listed companies that investors are warming towards?
We're seeing an increase in the mining and metal space, especially the uranium and the rare earths, because of just the world as it is now. Pharmaceuticals, tech companies, cannabis was, hugely popular a couple of Stefan, you can speak to that, hugely popular about 2 years ago. It's coming back. So I think it depends on the market trends, but listing on our market is not the catalyst for trading to occur. The catalyst for trading to occur is the company has to have a good valuation, good financials, good story. And then you have to go out there and you have to market your story. You have to think of it as, okay, we have the car and you're putting gas in the car, but when you're listing on our market and you're trading on our market, you're not listing, you're upgrading to our trading platform, the premium one. That doesn't ensure that you're going to trade well, what ensures that you'll trade well, is all the other things that go with investor relations and visibility and non-deal roadshows. So this is a part of the puzzle. The puzzle is greater, and it has to be sustained by the company.
I would add to that. I'm sorry, go ahead, finish. Sorry.
Apologies, Stefan. But yeah, so I mean, I encourage companies to think about setting up the trading platform properly for investors to trade their security. However, the most important part of a company entering the US is to have a strategy that supports that trading. And by that, I mean, I know you can't come over to the US right now, but you do have to do the NDRs. You do have to do the webinars. You have to have a robust presence in the market so that people know who you are. Go ahead, Stefan, sorry.
I wanted to add to that. I think that you're absolutely right. Different industries and sectors will trend with popularity from time to time. As she mentioned, the cannabis industry was very popular in 2017 and 18. So we saw a lot of activity in that. And there were a lot of cross listings in the United States, domestic companies, but also from Canada and the UK that were listing on OTCQX to take advantage of having more exposure to US investors while that industry was growing in popularity. But in addition to that, I would like to add that not only is it just a sector or an industry, but it's also geographical location, because foreign diversification has always been a very popular thing for US institutional investors. And so companies that are trying to rebalance a portfolio to get more exposure to Australia or more exposure to Western Europe, in many cases, the industry or sector is not as important as the fact that the company is based in a foreign jurisdiction that needs to be reallocated to rebalance a portfolio. So you might be Australian mining company, you could be Australian biopharma company. The fact that you're Australian might trump all of that, because the portfolio manager or even the sophisticated investor needs to get more exposure to Australia for whatever reason that might be, whether it's a play on the economic growth forecast of Australia, whether it's having more currency exposure to something that's uncorrelated to other currencies in the portfolio. So that it's really multifaceted. So I think it's much greater than just industry or sector. It's also geographical region.
A question for Blake. How difficult is it for a client to transfer a DTC holding to an SRN holding?
So to switch back and forth between markets, it's just a case of submitting a what's known as a shunt instruction to us to say that you want to move across to the OTC markets, or vice versa. And then we process that and work with the other transfer agent to move the stock back and forth between.
Is it a timely or a costly process, or pretty easy?
There's no cost involved to it from a registrar perspective from our side, and timely, it is a matter of it's processed within a day of receipt.
And maybe this may be a question for Andrew or Blake. What's the share certificate lodged? Is it an issuer sponsored or a broker sponsored?
Interesting question. As you know, in Australia, ASX doesn't permit share certificates, right? The US, for whatever reason, DTC still requires a physical certificate. So one is actually created. Oftentimes, we are the new transfer agent. We'll actually create one certificate, and we'll take an existing shareholder and have those shares certificated on the certificate. And it's required in order to deposit with DTC. And in reality, I think it's the only certificate actually created. And from then on, it's a pretty electronic system in the US as well.
Yeah, and just to add to that, for it to be passed across, so the origination comes from issuer sponsored. So if the account's CHESS sponsored, then it'd be converted to issuer sponsored in the Australian markets, and then we pass it through from issuer sponsored to certificated across to the US markets.
And we've got a lot of listed company executives and advisors on the webinar today, several hundred in fact, and a number of questions are coming on a similar theme. What are the key points to consider if you're looking at a NASDAQ listing versus an OTC listing?
So for a NASDAQ listing, you can go either way. You can do a direct listing, direct share listing, which is very rare, or you can do a listing through an ADR. So the consideration for a NASDAQ listing is, and there's an interesting article that was just recently set. I'll send it to you, David, so you can pass it around to everyone. But it was speaking about how companies list on exchanges to raise capital, and then they don't find it the exercise as fantastic as they thought it would be. But that being said, so for a NASDAQ listing, you would go through an ADR program, set it up with an ADR bank. You can do a level 2 or a level 3. A level 2 is simply just a listing on an exchange. That means there are no DRs outstanding at the beginning of the facility. So DRs have to be created through the creation of an ADR. Or you can do a level 3 listing, which is a capital raising in addition to an exchange listing on NASDAQ. So if you were to do a level 2 listing, it's not so costly. You would still have to do the 20F. Your financials still have to be in good form. Your 20F has to be reviewed by the SEC. You would still have to register your DRs with the SEC, and then the facility is open for creation of ADRs and secondary market trading once there's a pool of ADRs available in the US. If you were to do a capital raise, that pool of ADRs automatically comes available on the day of the secondary offering, because it's not a primary offering, because of the initial IPO was on the ASX, so it would be a secondary on the NASDAQ. So that would be more costly because you have an investment bank, you have you still have the SEC requirements. So a capital raise would cost you about, I would think, a little $1 million, maintaining that NASDAQ facility, maybe $500,000 when you think of, your cost with the DR bank, cost with your lawyers, cost with your accountants. It's cumbersome. This is why our market is a cost-effective alternative to listing on an exchange without having a capital raise. So I hope that answers the question.
Maybe if I can add a little bit.
Yeah.
I have half a dozen clients with Aussie clients, NASDAQ. And I have one going on at the very today. In fact, ironically, you mentioned just 2 hours ago, a client called. We were doing processing a compliance listing on NASDAQ, and now the client's thinking about doing a capital raising, so a level 3 program. But in broad brush, to your question, David, I would think for a company that one is just looking for secondary trading, so not looking to raise capital in the public market in the US, obviously OTC is the way to go. OTC is a lot easier to get up and running. The major difference, I think, that Violet's talking about, if you want to raise capital in the US public market, must go through the SEC registration process, which is a lot more involved in the OTC process, which is a relatively simple application. And the US process, unlike Australia, here in Australia, lodge a prospectus, 10 days later, with ASIC that is, 10 days later, no questions asked, you're off to the races raising the capital. The US has, SEC has a lawyer and an accountant review your registration statement. They take 30 days, they ask questions, you have to respond, you go back and forth. So it's a much more rigorous process. Once listed, though, actually, I think the cost, particularly if you hire us, aren't as expensive as Violet mentioned. If you hire a Wall Street law firm in New York, clearly it'd be in that ballpark. But once a company's listed, the only major obligation is to do an annual report on what's called Form 20F, and it's updating from the prior year. Otherwise, like OTC, everything you give to ASX, you give to the SEC. If you're NASDAQ listed, if you're quoted on OTC, everything you give to ASX, you upload onto the OTC market system.
Yeah, in addition to that, so if you're listed on NASDAQ or NYSE, there's a regulation, and it's not the SEC regulation, it's the exchange regulation, where you would have to solicit proxy from the holders. So you have to take into consideration that cost of distribution to all the American holders, and then just the cost for just getting all of those votes in, and so yeah, it's a little bit more cumbersome. And if you were to do a corporate action on NASDAQ or the NYSE, there's a procedure that's in place where it may cost you, if you do a ratio change, for example, or share consolidation, and I speak with knowledge because I used to work in the ADR bank. So NASDAQ and I think NYSE is now charging for corporate actions to be processed through their system. So it's a little bit, it's a lot more cumbersome in many ways. But again, we think of our market as the place you start, and uplisting is what you want to do in the future when you've established a great base, and it provides you that valuation to go and raise capital on those exchanges.
In fact, I recall seeing once or twice on the OTC newsletter each month showing their graduates.
Their graduates, yeah.
From OTC to NASDAQ. So actually, I think OTC actually applauds it. So it's it could be viewed as a stepping stone. And to give a sense of the ultimate, we talked about resource companies. One of my clients actually just now, yesterday, a major event, and that this is a Piedmont Lithium, which went ahead and did the NASDAQ listing and now redomiciled as a Delaware company and converted. But they raised significant amounts of capital in the U.S. public market. But I think as Violet's saying, particularly for smaller companies, perhaps starting off with the OTC markets, and we get to sufficient size if want to raise capital in the U.S. public market, then upgrading to a NASDAQ listing.
Yeah, I think Piedmont, I used to manage their program. They actually went from OTCQX to NASDAQ, and they've done a couple of secondary market raises on NASDAQ, and they're doing quite well. They're in the lithium space. So they're a great story.
This question, we've got a few more questions, and I'm just conscious of time. Stefan, I'm not sure if this question is directed at you to give you more work or reduce risk, but we'll throw it out. Has there been any thought, given the global nature of the OTC and the companies on it, to trade beyond the US trading time to reduce the risk for market makers, first of all, but to also enable a greater transparency, I suppose, if you like, between, for example, the ASX trading and the OTC trading at the same time?
Well, so we separate our desk by region. And so we have our European traders, we have our Australian and Asian traders who are the same desk, and then we have a small team of Latin American traders. So the Australian Asian traders have the most difficult time because there's no point during the day where the time zones overlap. And so they are truly making markets and putting risk capital in order to take on positions. We have very sophisticated systems that we have been proprietary, put together by our software programmers, which take into account the previous day's close in Australia, currency fluctuations throughout the day, news monitoring, both corporate specific, but also country specific. And our traders have, with that and experience, developed a way to kind of mitigate risk compared to our European desk, where the markets and the time zones overlap. And there is 3 hours during the day before London closes, and we actually have access to aftermarket trading in Europe through our counterparts in Europe. So it is a risk for us. That is the essential business of market making, that we have to price ourselves effectively. If we get it right, that's how the market maker earns his money. It's the spread. If we get it wrong, we lose money. And or you're picked off by a competitor who sees a price anomaly, or we've mispriced ourselves, or there's an arbitrage opportunity. But those are some of the intricacies of market making. But essentially, yeah, that's over the course of time, you learn ways to mitigate that by building into your system ways to just lessen the risk and the exposure. Sometimes that means covering your currency the minute we effect the trade, and then trading the security later that night or the next morning. Sometimes it means laying off exposure to a competitor. So it's multifaceted. There are a lot of moving parts, and that's what our guys do very well in order to make sure that there is best execution for the customer, because that's at the end of the day what we're graded on, and we do everything we can to try to make sure that happens, which also makes the issuer experience on QX more enjoyable, because they're not going to have angry shareholders who wonder why was my trade print so far off the previous day's close in Australia. And so that's what we try to do. And I think that's how we differentiate ourselves from our other competitors, because we've invested in these systems in order to allow us to do that.
And do you have any obligations in regards to volume?
Well, the only volume obligations would be, depending on the share price of the security, we have to be good for a certain amount of shares on the bid and on the offer if we're a market maker. Those obligations are really a domestic obligation, but we don't have any obligations to an issuer per se. So those are domestic FINRA regulated volume size requirements based on the price of the security.
And maybe this is a Blake Andrew question. In terms of raising capital, what's the most productive way to do it through an OTCQX QB listing? Are there any you mentioned restrictions around secondary raisings? Are rights issues, for example, possible? How do you raise capital if you do need to or want to those investors in the US?
I think maybe I can take that one. You do the capital raising as you do in this country. So if you're doing a placement to sophisticated professional investors in Australia, you can include a placement to institutional investors in the United States as a private placement, as well as other countries. We advise on other countries as well. A rights issue, an entitlement offer. Same, well, basically, you do it like you do for Australia. For the US and frankly, the rest of the world, it's limited to institutional investors only. So you would exclude your shareholders trading on the OTC. They would be excluded, okay? In fact, when when a company goes into a trading halt here on ASX for a day or two, to the extent the company is quoted on OTC, they should also go on into a trading halt on OTC. That's actually done not directly through OTC, but actually through FINRA. Again, that's the regulator for the OTC markets. So there is some coordination. The announcements, the robust announcements that Aussie companies often make for announcing a capital raising in Australia, we sometimes have to tone those down a little bit for lodging a comparable type announcement on the US markets, because you can't use an announcement to basically promote a capital raising in the United States. So there's that sensitivity. But again, OTC is for secondary trading only, not for the raising of capital. If you want to raise capital in the United States, it's done either as a private placement, or if you want to do a public offer, you have to go through the SEC registration process and really list on NASDAQ.
Blake, is that one of the challenges, I suppose, and it's no different, I suppose, to a listing in Frankfurt or in Germany, where your ability to tap your retail investors in that market is a little bit harder through rights issues and the like?
We don't see it so much, because it's kept quite separate. Where there's a rights issue on a listed company, it's purely carried out over here, and it's accepted that way that the regulations work.
And again, to emphasize, the reason why you can't extend a rights issue entitlement offer to all shareholders around the world is that it would likely constitute a public offer, whether the United States or any other country, and it would be an illegal public offer in the United States, absent registration with the SEC. And so that's obviously the inherent problem. Again, OTC, it's strictly for Australian companies. Unless you're an SEC registrant, it's just for secondary trading only. But to the extent the company wants to access US investors, institutional investors in particular, that is possible to be done as a private placement in connection with a placement in Australia or a rights issue or an entitlement offer as well. Just give me a call, I can help. And I must say, there have probably been, again, over the last 15 months, like 100 companies, Aussie companies who've helped raise capital in the United States. Mostly in the private placement, there have been a half a dozen in the public market in the US, but it's mostly private placements.
I'm conscious of time and the fact that we were looking to keep this to an hour. We do have some additional questions, but what we'll do is take those offline and deal with those directly with the people who asked those questions. Thank you to all of the attendees for tuning in. I hope you found the event informative and learnt about the OTC QX QB and the opportunity to engage with US investors through that market. I'd like to thank each of our presenters, Violet, Andrew and Stefan, for the insights you've given to the audience, and also Blake for joining us on the panel to bring another Australian perspective to the OTC process. So on behalf of Chapter 1 advisors, I'd like to thank everyone for attending and participating, and for our presenters from the OTC and the advisory partners for the role they've played in providing this very educative, got that wrong, webinar.
Thank you so much, David.
Thank you for
Thank
having
you,
us. David.
everyone.
Bye-bye.